This brief presentation about funding long-term care for those who need to pay for their own care and are worried about their savings. The average annual cost of residential care in the UK is now more than £30,000, and most people entering care don't have large private pension schemes. Therefore, after contributing their state benefits, such as state pensions and attendance allowance, there's often usually a shortfall of more than £20,000 every year paid from savings that usually includes the proceeds from the sale of the family home. So let's consider a particular case study. In this example, Betty had been receiving care at home for some time, but her dementia had worsened, and without very expensive round-the-clock care at home, she could be at risk. So her family decided she'd be safer in residential care. Betty's monthly care fees are £2,300, and after deducting her state benefits and small private pensions, the total comes to £800, so the shortfall in meeting Betty's monthly care fees is £1,500 a month. Her total savings, including the sale proceeds from her property, are £170,000, and her family are worried about Betty's savings running out. So what are the options? Could Betty's care fee shortfall be met from bank deposit interest? Unfortunately, interest at say 2.5% per annum would only produce just a little over £350 a month. So this would need to be topped up by large capital withdrawals, rapidly reducing Betty's savings. Let's now consider how quickly savings could reduce. In this oversimplified version, assume Betty's care fees are paid annually in advance and that the cost of care increases by an average of 5% per annum, and yearly interest on deposit remains constant at say 2.5%. Here we can see how quickly savings can deplete. In reality, Betty will never be in a negative situation. This is because her money will stop running out at the current threshold of £23,250. At this stage, the local authority will be obliged to pay Betty's care. However, she will still have to contribute £1 a week for every £250 of savings until her money reduces to the present lower threshold of £14,250. One possible solution to ensure Betty's care fees will not reduce most of her savings is to purchase a single payment care fees plan. This is a lump sum insurance policy that will guarantee to pay a monthly amount for the rest of Betty's lifetime in care. Let us take a closer look at how this works. The care plan pays a guaranteed amount of money that could cover Betty's shortfall. However, care fees can increase each year so that an extra nominal cost, it is possible to ensure that the payments will automatically rise by say 5% every year. These policies have a number of knobs and whistles, including a deferred option whereby you can choose to defer commencement of payments for up to 5 years. A longer deferment period results in a lower purchase price simply because the insurance company has held the money for a longer period without having to pay any benefits. The care plan policy is a type of annuity, whereby people who die early pay for those who live longer. Therefore, on early death there is often no return, with the exception of one particular insurance scheme that will return 100% on death in the first month, reducing to nil after the following 6 months. However, it's possible to insure up to 3/4 of the purchase price, less the payments already made that are refunded on death. So this is a form of reducing protection. And for people who don't wish to sell their own home, it may be possible to obtain a care plan by way of a loan against the property. No repayments are necessary, as the original advance, together with rolled-up interest, can be repaid when the property is sold. Unlike equity release, the owner needs to vacate the property to enter care, and the house can then be rented out. Single payment care plans are underwritten by insurance companies who have different views on life expectancy related to age and medical conditions. Their quotations are based on a medical report completed by the person's GP. They may also contact the care home for up-to-date information on the person's health. Presently, there are only 2 insurance companies offering these schemes, and sometimes their firm quotations can differ by thousands of pounds for the same guaranteed monthly income payments. So let's look at how a care plan can work for Betty. In this example, Betty's family decided to purchase a single payment care fees plan to cover the £18,000 annual shortfall in Betty's care fees. Also, they chose to pay a little bit extra so that the payments will automatically increase by 5% every year on the date that the care home reviews its care fees. The cost of the single payment care plan is £72,500, including the automatic 5% annual increase facility. So the price is fairly typical in that it equates to a little more than 4 years of shortfall. The rest of Betty's savings are now virtually ring-fenced and can be left to grow without the risk of her money running down to the lower limit, presently £14,250. Because Betty is unlikely to need most of her money on deposit, it may be possible to pay some of her money into investments for the longer term that could produce higher interest rates for her. And to summarise, people in care and their families benefit from peace of mind with the care plan in knowing that the cost may be capped in exchange for a single payment. This can also help remove the possibility of distress caused by the person in care having to move to another care provider that will accept local authority funding rates. On the other hand, care providers benefit because they retain their customers for life at self-funding rates. Also, payments are not subject to tax on the person in care when paid directly to a registered care provider. Please remember, a single payment care plan should be taken out at the time a person enters long-term care or is actually receiving long-term care at home or in a residential or nursing home. Finally, I'd like to thank you for watching this short presentation, and please don't hesitate to email your questions. Alternatively, for an informal discussion, simply free phone 0800 084 2804. That's 0800 084 2804. Thank you.